Hey everyone, welcome, aloha. Here we go with the Federal Reserve, the monetary policy, the Federal Reserve System. Thanks for joining me. Glad you're all here. Hopefully the sound is working well, and I've got a microphone recorder, so hopefully it's a little better than just the computer audio. As you know, I don't go back and redo things, so this is going to be live, cinema verite, all accidents and mistakes included. And here we are with the introduction to our Federal Reserve Unit 2020. And if you're following the directions, and clearly you have because you are now here, we're going to take a look at just a little bit of explanation about what the Federal Reserve is and what monetary policy is. And we're going to do that, and then we will, of course, jump into fiscal policy and a screencast on Keynes and Hayek, two major economic theorists, and how their work has influenced the 20th and 21st century. And that'll set us up for a cool National Geographic Inside the Federal Reserve video, where we'll get to find out how gold is melted down and what your money really is. So let's start with monetary policy. And some terms we're going to talk about. Terms, people always put up terms like, hey, these are the terms you're going to know. And everyone's like, yeah, just tell me when I get there. But very quickly, inflation, we're going to know what that is. We're going to learn about monetary policy, the devalued dollar, because that's alliterative, the Federal Reserve, which is what the title was, discount rates, we might get there, open market operations, and business cycles. That sounds fancy. Don't worry. Much of this is very, very unfancy. So, what is my, by the way, shout out to the students. And a couple of years ago, we had students make these presentations in groups, and they did it much better than I could, with a lot more pictures and bells and whistles. So thank you to them. What is monetary policy? Monetary policy is actions taken by the central bank, like a Federal Reserve. You may, what is a central bank? A central bank is basically a bank that helps to organize and control the finances of a country. There are European central banks, the European Union. The Federal Reserve is a central bank. It is not like your Wells Fargo. So what do? They have a couple of goals. They want to promote national economic goals. We'll get into inflation and unemployment later. And they are usually pursued by advanced economies who are able to have central banks. And they like to promote macroeconomic challenges for emerging market economies through capital flow and exchange rates. That sounds crazy. There's a lot of terms in there. We never even got around to the idea of macroeconomics. If microeconomics are the concepts of what you and I are going to decide to buy, or supply and demand, or even businesses supply and demand, macroeconomics is the ideas of nations, gross domestic product, large economic indicators, and moving capital flow, sharing money to countries that don't have it, creating new markets, and creating exchange rates where people can borrow and lend money. So, Federal Reserve. Remember 1913? Of course you do. It was that wonderful year after 1912 when William Howard Taft lost the election. He didn't actually lose the election. I don't even think he was running. Theodore Roosevelt was running as the Bull Moose Reform Party. Taft was probably running, actually. And Woodrow Wilson swept in, split the divided Republican Party, and won election as progressive Democrat. One of the things he was calling for was not only an income tax, thank you, Woodrow Wilson, but the creation of a Federal Reserve, thus fulfilling the promise that was destroyed by Andrew Jackson when he destroyed the Bank of the United States in the 1830s. Shout out to U.S. history for that one. So what does it do? It gave central banks, the Federal Reserve, the power to set monetary policy. And when we talk about monetary policy, you may notice that the word money is kind of in there. And in fact, monetary policy is exactly that. It's about the money supply. They adjust the money supply in order to obtain a more stable economy. So monetary policy is about money. What's it about? Money. You may be wondering, hey, how many Federal Reserve banks are there, Mr. Stewart? I would say there's 12, an even dozen, with 25 branches. Why 25? Because there are. You will also notice, we'll hopefully do a little bit later, if you take a look at your money, if you have your money will tell you which Federal Reserve mint made it. There is one in San Francisco. Take a look at the letters and figure out how to read your money. There are board of governors. It's a 7-member board, and they set bank reserve requirements. That means how much money banks are supposed to have in reserve in case they need to pay it out again. In other words, not to loan it out. They control the discount rate, which is the rate in which banks and others can borrow money, and they make other economic decisions. That's code for other things we don't want to go into. So the monetary policy mission, because everybody has a mission. Here's the mission. It's the goal is to increase employment, right? People like jobs. It is to stabilize prices, and it is to have moderate long-term interest rates to support long-term economic growth. In other words, everything's just right. It's the Goldilocks of monetary supply. Just enough employment keeps going up. Prices are stable. Everyone's doing pretty well. And there's the interest rate at which it takes to borrow money for houses or businesses or mortgages is just high enough that not everyone's borrowing money, but that the people who want to can. And that's going to cause the economy to grow stably over the long term. How do they do that? There's several tools. They can change the reserve requirements. They can say, banks, you know what? We said you had to keep 20% of your money on hand. Now you only have to keep 10%, or now you have to keep 30% of your money on hand. They can change the discount rate. And we've seen they've just done that recently. And they can change open market operations. And what are the effects of the monetary policy? Well, they influence the economy and inflation. They can influence the value of dollars, and they can influence unemployment by using these tools. So, how might it stabilize the economy under the category of stabilize the economy? There are changes in the reserve requirements, which we talked about. A portion of the members' bank's deposit must be retained so bank loans can be made. And if people wanted to come and get their money, they can. So there aren't runs on the banks like we saw in the Great Depression. Or during the 2008 crisis when banks had given out too much of their money and owed too much, and people were concerned about that. There is, of course, a change of the discount rate, is at which member banks can borrow money from the regional Federal Reserve Bank. Banks basically borrow money from bigger banks. And the big banks borrow money, that's alliterative and hard to say, is from the Federal Reserve. They don't borrow money from you and I. And so that interest rate, which is very, very low at the moment, is the rate at which banks can borrow money. They also can sell or buy government securities. We'll talk a little bit about that, but bonds, treasury bonds, other things in the securities market, which also is a way of dealing with how much money there is in the economy. And essentially, there's a link between the monetary policy and the economy is the balance that's held by the Federal Reserve banks. So what are the motives for doing this? We want to keep business expansion going. We want to keep the dollar value just sort of lowish, but not too high. Because if it's lower, then you will decrease imports and you'll increase exports. And in theory, we want to export stuff to other people. We want it to be cheaper for us to sell goods to other people and not so conducive for other people to sell goods to us. Basically, the reserve is about 15%, give or take, to keep funds in this range of what banks need to keep. And basically, well, we'll skip some of that stuff, actually. Next, the issue, of course, comes with one of inflation. Inflation is when prices rise faster than perhaps they should. And if that's the case, then the Federal Reserve can reduce. Oh, sorry, I take that back. Inflation happens because of two things. The Federal Reserve has reduced rates, and that creates stronger demand for money, and that leads to higher prices and higher salaries. That also, however, boosts production. If more people want more stuff, then more people will make more stuff. The main function is to moderate the highs and lows caused by the free market of the banks. We don't want things to be up and down. We want things to be nice and kind of gradually getting higher. In good times, banks lend money. That increases the money supply, and that fuels a little bit of inflation. In bad times, banks tighten credit. They don't give it out as much. The money supply decreases, and that could lead potentially to recession. Now, currently, our Federal Reserve Chairman is Jerome Powell. Back in 2015, when interest rates had been super low for about 7 years after the Great Recession of 2008, they began to raise interest rates, and they were gradually raising it further because people were worried about inflation. Now, thanks to the 22 million people who filed for unemployment in the last month or so. Rates have been dropped to almost zero, making it essentially free to borrow money for banks, and being able to then create lending between banks and money in the economy just in case. So the question, of course, that the Federal Reserve is always grappling with is, when should rates rise? They shouldn't be raised too quickly, because that will constrict the money supply and throw people out of work and make it hard for businesses to pay back their debts. But low rates have been in place so long, then you have that risk of inflation and things being valued more than they should be, bubbles, which we all know are dangerous. Stay tuned for questions when we have our office hours. So that's essentially the Federal Reserve and monetary policy. This is Works Cited. Check it out. It's fun. You always like to cite your work. Stay tuned for our screencast on fiscal policy, followed by our screencast on Keynes and Hayek.